Well, let's return to the advisory and the issue of superannuation. It isn't automatically covered in your will. So what do you need to do to make sure that it is and it's a valid binding nomination? For more, we're joined by Roger Perrett from Freshwater Wealth. Roger, welcome back.
Thanks, Andrew.
So is there that assumption, I guess, that among many who have super and perhaps at their retirement phase or setting up a will that it is covered? And if it's not, if you haven't specifically outlined that, what do you do?
Yeah, that's right. Look, your superannuation can go as per your will, but not necessarily. So we'll talk about this today, but I should just mention that, for people watching, maybe in their 40s, 50s and 60s, people thought, I'm not going anywhere, this isn't really applicable for me. But we're faced with the biggest wealth transfer in history right now, and maybe we should consider this not only for us, but for also our parents. So the three things I think when we're, considering strategies in terms of what happens with our super when we pass away, one is obviously tax. We want to minimise that. Two is speed. And I guess the third one is we obviously want to make sure the right people get the money when we pass away. So maybe we could go through those today. And I do have a bit of a teaser. We'll go through a strategy that could save potentially hundreds of thousands in tax if we get this right.
Oh, wow. Okay. All right. We're listening intently then to see how this is going to work if you're talking about those cost savings. All right. So take us through those stages then. And I mean, so you've got a will. Do you need to specifically spell out what your super is, what it's held in, how much of a detail do you have to go into in the will?
Yeah, sure. So superannuation in many cases is actually outside the will. Okay, so you don't actually have to refer to it, and you can actually make a nomination within your super fund or with your super provider where the money goes. So the money in super doesn't even have to go as per your will. You can nominate, and it's a completely different nomination, if you like. So yeah.
All right, so that's sort of where it goes then. You talk about what type of nominations should people consider then?
Yeah, sure. So I think I'll put something on the screen. I'm not sure if we've got that, but there's a number of different types of nominations. So the first one you can see there is no nomination. And obviously this is the scary one, because in this case it's the trustee discretion. So this is where the super provider gets to actually choose where your money goes to. So not ideal, and a lot of people don't actually make a nomination, but there's obviously a high degree of risk there, not much certainty.
Goodness, is there a possibility that it would not be a family member?
Not necessarily, but it's still, you're putting it in someone else's hands.
Yeah.
You're not having the choice in that respect. So that's the first one. The second one is what's called a non-binding nomination. It's also called a discretionary nomination, and that's really guiding, or it's guidance only for the trustee. The trustee doesn't have to actually honour their that nomination. Now they're not doing that in a sinister way. The reason for that type of nomination is so the trustee can overrule the nomination. Let's just say, for example, there was a marriage separation, or maybe someone predeceased, and there's the nomination's no longer valid. So it's not as sinister in any way, but still it's only giving guidance to the trustee, and it's not really, giving all that much confidence, if you like.
Now you also talk about structure, how that matters, particularly if you are in the pension phase.
Yeah, I might just go through the last two. The other one,
yeah,
is binding lapsing. So in that one, it's legally binding. The trustee must give it to that person you've nominated, but that expires every 3 years. The trap there, it depends on the trustee, but it often goes to a no nomination after 3 years. So you think you're all sorted, 3 or 4 years go past, you forget to re-nominate, and you've actually back in the no nomination category. And then the final one there is binding non-lapsing. So that's sort of binding against the trustee, but you don't have to redo that nomination every 3 years. So that's certainly a popular one. To answer your question there about pension phase, so when someone passes away, it's an easy, result that you could actually receive the full amount from that person's superannuation. But what it means is, in that case, let's just say it's your partner, the super provider has to sell down all the assets, then they've got to pay you, and then in many cases the recipient or the partner then goes, well, how do I get it back into superannuation? There's obviously restrictions and rules in doing so, and they may miss out on a lot of tax benefits going forward. So when people are in pension phase, meaning they're getting that regular income, they're retired, there's a beneficiary type called an auto-reversionary beneficiary, which basically means instead of having to do all of what I just spoke about, we basically just change the name of the account. Okay, so it just goes automatically, changes name to the partner's account. The investments don't have to be sold. In many cases, the recipient or the beneficiary doesn't even miss out on a month's worth of income. Everything just continues on seamlessly. And basically the recipient also keeps, or hopefully keeps, the tax-free status of the pension as well.
Roger, where does this all fall apart? Potentially where you could be losing money where that's not necessary. Does it come down to tax?
So there's a couple of things. So I might share like two stories. So sadly, just someone recently passed away, and a new client came to see me. A very large estate, so a large home, and also their superannuation. The superannuation, though, was on their will. Instead of nominating, in this case, the daughter, the lady had nominated her estate. So it goes as per the will. Now, when this happens, it goes through the will. It has to go through this process called probate. It has to get approved by the courts. And in some cases, that can take 3 to 6 months. So I know this sounds very, very strange, but sometimes you can inherit millions of dollars and it can put a huge strain on you financially until the money is paid. So if you think about it, if someone passes away, you've still got to maintain their home. You've still got to potentially get the home ready for sale or for rent. Now, if you can't access that money from the estate to pay for that, like it's going to come out of your pocket. So if people are already stretched financially, yes, they've got this big inheritance ready to be paid to them, but they may have to be coming up for funeral costs, all these expenses until the estate or probate's been given. So I think one of the things to answer your question, how this unravels, is speed, making sure that not only we're minimising tax and the end beneficiary is receiving the money, but we're also making sure they're not going to be under tight cash flow issues themselves, just sorting this out, once you've gone.
All right. Any other issues then to consider?
Well, the second big one is tax, of course. So I know we've discussed this on the program before. So if someone passes away and the super goes to your partner, a financial dependent, it's all tax-free. So it's tax-free while you're alive, tax-free when you pass away. Superannuation is fantastic. The issue is when both people pass away, or ultimately when both the husband and the wife, or the two people then pass away, when the money goes to a non-dependent, like an adult child, part of the superannuation can be taxed up to 17%. Okay, so you can imagine if you've got $1 million in super, that's $170,000 that we can use. We call it death tax or death benefits tax, and obviously that is a huge one to consider. There's 3 ways that we can help manage this. So the first one is a bit tongue-in-cheek. I suggest people live a long time and spend all their money, because by the time, if you got to your 90s or into your hundreds and you've got no money in super, there's no money to tax. So it's not an issue. So that's the first one. The second one, if the person is like a widow or they've got no financial dependents, if they're in the circumstance, which often happens, that they're told they've got to get their things in order, they've got a limited time frame, maybe an illness, for example, in that case it's often better to take the money out tax-free while they're alive, rather than if they pass away, that 17% tax will apply. So it's not a robust strategy because we never know when our time's up, but certainly it is a strategy. And the third strategy, depending on your time frame, like your age, we can actually minimise or reduce the potential death tax by, bizarrely enough, taking the money out while you're alive and then putting it back in. And when we put the money back in, that means that when you ultimately do pass away, because you've done that round robin or recontribution, you don't have to pay that 17% tax. So they're 3 strategies to save money on the tax side of things.
Yeah, that third one is a quirk, isn't it? That's certainly worth consideration.
Yeah, that's right. It is a bit tricky because there's a lot of rules, not necessarily getting the money out, but there are restrictions getting the money in. So before people go, ring their super fund to Savo and pull all the money out, I do recommend getting advice, because we've got to make sure we can get it back in, because there are restrictions on doing so.